Most traders try to hedge their trade to improve their safety, but 90% of the traders are hedging it the wrong way. But today I will show you a hedging combo which will give you the margin benefit. Also, if market go wild, it's going to protect your trade, give you the maximum benefit, and obviously I'm going to show you how this is done in the real market situation. You're gonna learn something special, no doubt about it. Nothing common we do on this channel. Crazy ideas, things which are really effective. And this is also a leaf out of my option trading playbook. You've been hedging it wrong. Here's why. So let's start this very interesting topic. In fact, market has been super volatile. Market has been falling and the volatility is only going to increase in the future. Only with people who have proper planning and hedging techniques, they will not just survive, they will thrive. Why following the masses don't work in trading? Here is the prime example. Let me show you what everybody do, and then I'm gonna give you an alternative, and then we're gonna test that alternative. Ready? It's gonna be a fun ride. So here we are on an option simulator. When we talk about hedging, we have to talk about the naked option selling, and the strategy which tops the list is a short strangle. And this is the prime example of short strangle, is that we sold an out of the money call and we sold an out of the money put, the most famous strategy ever. Now, if I tell an option trader to hedge it, and I don't want an unlimited risk, what this trader is going to do most likely 90% of the time is that he will buy a protection. So if he sold 23,500, he's gonna buy the next strike probably 23,600, and the sold put which he sold, he can buy a put which is slightly lower. And this is how the hedging happens, because this is what books tell you, this is what the internet, the websites tell you. This is how the hedging happens, and this is how it looks, right? So now the losses is obviously capped here, and if market stays between this range, this is going to be your maximum profit. And if market trends by any situation, if market gives you kind of gap down or market go, then your trade is going to be in loss. And that's how hedging happens, is the common wisdom of options market, and the story ends there, and that's it. You know the option trading now, and then just keep trading this for next 5 years and count it as experience. No, there is a different alternative way to do things. How do we do it? Let's understand. First of all, we don't need to buy the same series to hedge it. We don't need to do it. What we can do is we can long the same strike, but in the weekly options we can do. Why are we doing weekly option? Number one, it's going to give you a lot of comfort because it's going to give you margin benefit. Plus, the premium of weekly option, it's very economical and you're buying it out of the money. And this is for your protection in situation of any kind of a crash of a market, or if market suddenly gives you kind of gap ups. Now you see I've just added one leg, which is a put, which is at a very less premium comparatively. We sold for 141 and we're buying for 21.95. If market gives you some kind of a gap down, don't worry about these red, these things which you see. This is only till expiry if you hold on to the trade. But remember, whenever you have a payoff graph which has two expiry involved, payoff is not accurate. So we're going to do both sides, because ultimately we do options trading because we don't know if the market is going to go up and market is going to go down. In fact, we have just scratched the surface now. I'm going to go more deeper with this with you, and let's see how this looks like. And when we do this, this will look something like this. Okay, like I said, don't worry about this. We are not holding it in expiry. And this call and the put which we sold, it's going to behave as a short strangle only. Clear? Now I'm sure all of you who are watching this video right now got an idea, which is good, but you also want me to show you how this kind of hedging technique performs in different market situations. I'm going to give you that edge for sure, but before that, there are certain points which I want to tell you. That is maximum profit here, it's 20,397. How much capital are you deploying? You are deploying approximately 88,000. So 90,000 we deploy and we get the maximum profit of 20,000. That means your peak ROI is approximately 23,000. If market gives you a trend, this maximum profit which you see can also expand. And there are a lot of techniques which we can do now with the market. But let's see, I want to show you a big, nice trending month, which I'm sure you would like to see how this works. So let's start afresh, and we're going to take an October series contract. This is 27th of September. So what we can do is, first, let's put a short strangle in place, just like public. But we're not going to hedge it like public. We will get the margin benefit, but we're going to do a lot more smartly. So let's just sell a call first, which is easy. And then we're going to sell a put. And then we're going to buy hedging. How easy it is. And I'm just picking strike out of random, just out of the money. And this is how it looks, a usual short strangle. But instead of converting into a condor, what we can do is we go to the weekly series, obviously, which happens to be around 3rd of October. This is where the game starts, where we're going to hedge it with weekly. But I'm sure what you must be thinking, that weekly contract is just only for a week. What is going to happen when that week expires? In that situation, what we can do is what I'm going to tell you, but one step at a time, like I said. So here we buy the weekly put. At some point, you have to stop consuming random strategies and focus on what really works in market. Let me tell you, the techniques which are special, they are special because public don't have access to it, and it's out of the box thinking. I know that's why you come on this channel. Now let's see what happens now, and I'm gonna tell you what to do if the current week expires as well. Very interesting. I'm sure so far you like it. Don't worry about the payoff. That is not much of a relevance here, and etc. We know it's hedged. Now let's see what happens now. Okay, market is going down, it's drifting, it's fine. Tuesday have come and market has really gone down now, right? Let's see some more, and we have come on Thursday now, which is 3rd of October. What do we see now is to be made note very carefully. That is, the overall profit have come in a trending market. Why do you hedge your position? I want to ask you. You hedge your positions because you want protection against a rapid, fast move. Am I right? Yes. So this is the example where market moved, because if market don't move, if market stay where market is, the short strangle which you made is going to give you theta decay. That is your prime focus. But a trending market, imagine instead of this, if someone makes iron condor, short loss. If any kind of trending move, because you are selling and then you're buying and you are leaving some space. Here you are not leaving any space and you get it. One more point which is very important, which you must keep in note. Suppose that if somebody don't do this hedging, and the two positions which you have, minus 4911 plus 2866, that means the original position give you really crazy loss, but because you were hedged, so this you are buying a call of 10 points. So economical call you're buying, and you're buying the put as well. Put is always going to be expensive, usually around double the price the put is going to be, because the IV of the put is always higher. Now the mistake which you can do is probably you can match the premium. Again, it's super common, everybody do it. Matching premium in a neutral strategy, it's never going to work because there is a volatility skew. It always gonna be skewed, not always on the put side, sometime on the call side as well in a bullish market. So it's better to probably go by deltas or equidistance. That works much better. So very, very intelligent way to trade into the markets. But now I want to tell you certain things more about this, how you can make it even better. Now I'm going to tell you things which will really have a good positive impact. First things first, which you must know, if you do not have an edge, you are an edge of somebody else who can trade a lot better than what you do. So keep that in mind, and exits based on the new reduced margin. The ROI which you need to calculate is to be calculated on the margin which you deployed, not just a short strangle margin. Obviously, I want to explain this a little bit more. This is your original position. The ROI which you will be calculating will be on 88,000. Number one. Number two, suppose you are entering from week 1 to week 2. Do not square off your buying positions first. Otherwise, your margin gonna jump up and you may get a peak margin penalty. So buy the next week first and then exit the current one. That makes sure that you are not getting hit by any kind of a penalty, or sometime broker also auto square off. That kind of an issue, which is very common. It's not a common issue for us, so that we are not giving any profit which we already made in this when you entering from 1 week to another week. Market really punishes hesitation. Market punishes wrong execution of order. If you are somebody who's really serious about option trading business and you want to learn the top shelf stuff, the techniques, how do we adjust the trade, the profit booking, everything, all you can do is you can contact and ask for support. How can I learn it better? How can I improve my trading even more? And improvement should not take months or years or 10 stop losses. Improvement can happen overnight as well once you have access to better, superior knowledge, which probably propels you where you want to go. Sometimes we have to get out of our own way to get access to the top stuff. Now, I want to tell you one more point. Upon one weekly expiration, enter next week to remain covered. Just like I said, don't just square off your call and put. It's not advisable. Buy first and then do it. And now the third and the most important point, sort of a reward for people who watch the video till the end. If you want big range, this is even better. Now, a lot of working professionals obviously watch the video, they do contact, etc. So people who are already working, who are busy, they like to play big range. They're happy and content with probably 2% in a month, 2.5% in a month, but they want big fat range. When you sell a call or a put, which is 1,000 points out of the money, things are good till the time the range is not, challenged. But as soon as the range gets challenged, then your knowledge about option trading will be put to test. I have a good news for you. With this kind of hedging technique, imagine buying a weekly put which is 1,000 points out of the money, call and put. It will be like some 5-10 points only. So economical. Plus, any kind of a black swan events, that gives you a lot of protection. Now, obviously, protection is not 100%, can never be, but at least you will be better than other 90% of the traders who are either hedging by monthly options or they are just selling naked options out of the money, which in my opinion is definitely a suicidal move for your demat account. That's not really good. There are definitely better ways. That's why I tell you, hit and trial way of trading one must completely avoid. You can elevate your trading game. You can learn the craft in record time. You can get in touch to learn in depth. Just drop a message. You can get details directly from the team. Also, there are a lot of things which we can do in this. If market is moving and we are not into profits, there are certain things which we can do. Drop a comment. Let me know if you want me to make a second part of this. If you think that you want to learn more about this, and I have a lot of things to tell you how you can do this, but at least it's a good head start. At least it's like, 20% of the overall picture. But even the 20% is much better than how public trades. So I'm sure you must have learned something really good today. Make the best use of the knowledge which you gain from this. Think about it, meditate over it, and think about next time when you're selling an option, naked option out of the money. Remember that you learned something from someone over YouTube. Maybe when market is trendy, this little trick which you just learned can save your trading account. Thanks for watching, and like I always say, you are going to do so well in trading, you will surprise everyone. I wish you all the best. Bye-bye.